Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you haven't been here before, my name's Tom, as the name suggests. If you enjoy the video, hit subscribe, like, leave me a comment, but for now, let's get into it. So today I'm going to get a little bit controversial. I'm going to go ahead and say something that a lot of investors probably might not agree with, but I'm hoping I'm going to be able to change some minds with this video. And that's the fact that I don't actually like dividends. I'm not a huge fan of dividends, and I want to run you through kind of an extreme example of where not paying a dividend can be actually really powerful and really beneficial to investors in a company. So there's sort of one main reason really, there's one sort of more minor reason as well, but the main reason why I am not a fan of dividends is typically if I'm invested in a company, I typically like to invest in companies that have quite high return on equity, ROE, and generally also quite high return on invested capital, ROIC. So if you're not familiar with these two numbers, return on equity is essentially, it looks at the total equity of the business. So what does the company own? If we were to pay off all its debts and sell everything that the company owns, that would be roughly what equity is. What sort of return does the company generate on that equity every single year? So typically I'm looking for at least greater than 10%. So if a company has equity of $1 million, typically they're able to earn at least $100,000 a year, 10% of that number. But I'd much prefer that figure to be more like, say, 15 or 20% where possible. So that's return on equity. Return on invested capital is largely the same thing, but it also looks at the debt that the company invests. So in the same example, if we have $1 million of equity and then we also have $1 million of debt, that gives us $2 million to actually go out and invest and try and make a return on. So typically you'll see that return on invested capital, if the company does have debt, is actually lower than return on equity. So I'm still looking for greater than 10%. And typically the companies that I'm invested in, those two numbers will actually be quite similar. I tend to invest in companies that don't have a huge amount of debt. Debt can kill, as I'm sure you know. So I try to steer clear of that where possible. A little bit of debt strategically is okay by me, but I largely try to steer clear of that. So I guess why am I looking at these two numbers and how on earth does that relate to dividends? Basically my argument for not wanting to be paid a dividend is that the company can do a better job investing that money themselves than what I can probably do if they were to give that to me. So if a company earns $100 and they want to pay that out to me as a dividend, there's a couple of things that I can do with it. So one, I can go out to dinner, I can go out and spend it, and that $100 is going to go to zero very quickly. What I'm probably more likely to do, to be perfectly honest, is to try and funnel that $100 into a new investment. So I'm going to go out and look at finding another company to invest in, or possibly I'm just going to funnel that money into an existing investment. It may even be the company that paid me the dividend, for all I know. So that's probably what I'm going to do with that $100, but there's a couple of disadvantages to that. So if I have to go out and find a place to put that $100, you know, my target return is sort of around that 15% mark. So if I do my job really well and I find something quickly, there's a good chance I can earn on average about a 15% return on that investment. But there's also a good chance, especially in today's market, that I'm not going to be able to find a place to put that money. Valuations are very high. I'm a value investor, so I'm finding it tricky to find companies to kind of put that money into. So what's probably more likely to happen at the moment is for me to just be sitting on that $100. I'm going to be looking left and right for companies to put money into. That $100 is going to go into that sort of pile of cash I'm sitting on to try and put somewhere, and it's not going to generate a return. It might earn sort of 2 or 3% just sitting there in a savings account or something, but it's not going to generate anything too fantastic. But what will generate a lot of money is if the company retains that So this is the primary reason why I really don't like dividends. So if the company is earning a 10% return on equity consistently, that's a big caveat here. They've got to be earning that consistently, and the future of the company has got to look positive. So they've got to actually have places to continue putting this money if they want to go out and reinvest it. So if again this company earns $100, but rather than paying it out to me, where I'm just going to sit on it and earn 2 or 3%, or spend it, or possibly be able to find another investment, which would be, best case scenario if they did pay it to me. What the company can actually do is hold on to that $100 and use it themselves. And if they're generating a high return on equity, that means they're going to be earning at least 10% on that retained earnings. So if they're retaining $100, a year later they're going to have 110 from that investment. And they're also probably going to earn another $100 or $110 as their business continues to grow. And essentially they can repeat this process every single year. So the next year they might want to pay me $110. I say no, or I don't actually say no. I'm hoping no, they hold on to it. And they can continue to get this money kind of compounding and snowballing, and it can have massive benefits to the shareholder over a long period of time. So I just want to run you through a really extreme example of where retained earnings has done incredible things to investors, and I'm just going to pause the video to put a screenshot up for you guys to see, and that's actually with Warren Buffett's company Berkshire Hathaway. So have a look at this chart I'm about to put up. So that is pretty darn impressive. That's probably the most impressive stock chart you'll ever see. Basically, Warren Buffett started buying Berkshire Hathaway at something like about $7 in, I think, the late 1960s. Don't quote me on that, but somewhere around there. By around 1980, he'd compounded money so well that it was up to about $4,000 a share in about 1980. And as of today, so I'm filming this in early 2019, as of today, that same share is worth right around $307,000. So he's turned $7 into $307,000 over that period of time. And there's there's a couple of things that have helped him do that. He's the best investor that's ever lived, in my humble opinion. But there's one sort of thing that's really helped him to continue to compound money over time, and that's something called retained earnings. Retained earnings. So this is exactly retained earnings. So this is exactly what I was talking about in the kind of previous section of the video. Rather than paying out a dividend, Warren Buffett's held on to any profits that he gets paid from the companies that he owns. He owns about 70 private businesses through Berkshire Hathaway, and he also gets paid a bunch of dividends from public companies that he owns. But essentially that cash that he gets, he's famous for never having paid that out to the Berkshire Hathaway investors. He's never, in the history of Berkshire Hathaway, over the 50 or 60 years that he's owned a big stake in the company and has managed the company, he's never once paid a dividend. And even now, he's sitting on huge piles of cash and he just refuses to pay that as a dividend. And that's entirely due to the power of retained earnings. So Warren Buffett has been able to generate a return on equity, just like I was talking about in the previous section, of right around 20% per year right through his investing career. That's slowly come down over time. So when Warren was working with quite small amounts of money compared to what he's working with now, he was able to crank out 30 to 40% a year. It's slowly come down, and now he's sort of slightly above the market average through this sort of bull run, where he does tend to perform a little bit worse versus the average, not worse than the average, but he tends to do really, really well in down markets and sort of average to slightly above average in bull markets. He's probably right around 10% and kind of the modern Berkshire Hathaway. But essentially, if you compound money at 20%, you're going to end up with a lot of money very quickly. And that's exactly what's happened to Warren Buffett. He's continued to hold on to those earnings, and he's continued to have that engine kind of chug away, producing phenomenal results. And it's turned into a whole bunch of money. I mean, even here it was a whole bunch of money when it went from 7 to 4,000, but he's managed to continue that trend, and it's just got the old hockey stick curve compounding through the absolute ceiling, going to the moon. He's managed to generate massive amounts of money by retaining earnings. So that really is the primary reason why I'm not a huge fan of dividends. If a company's earning a high return on equity and a high return on invested capital, let them keep that money, let them keep investing it, assuming they've got somewhere to put that cash. And it should work out much more beneficial to do that rather than taking the money yourself over the long term. So that's the primary reason. I just want to quickly get into one more reason, so hang around for the next couple of minutes while I talk about one final reason why I'm not a huge fan of dividends, and then I'll leave you to your day. So hang around. All right, so there's one situation where I am a fan of dividends, and a second reason why I'm not a fan of dividends. So the one situation where I am a fan of dividends is again just to do with return on equity, return on invested capital. So if return on equity, as an example, is less than 10%, probably I'm not invested in that company anyway. If it is less than 10%, that is a big filter that I exclude a lot of companies from if they're not returning. If they're not making a high return on capital or a high return on equity, typically they're put either in the too hard basket or the not good enough company kind of basket. So they're probably not in my portfolio anyway, but let's just say they are for argument's sake. If they're making a return on equity of less than 10%, I want them to pay me a dividend. And the fundamental reason behind that is because I can probably find somewhere to put that money that's going to generate 10% or more on average, at least over the long term. Possibly not in today's market because prices are so high, in my opinion. But if they can't earn 10%, I definitely can. So send that money my way. That's essentially the only time I want to be paid a dividend. So let's get into the final downside of dividends, and that's to do with tax. Our good old friend tax kicked us in the butt with dividends in a lot of scenarios. Not so bad, to be honest, in my situation here in New Zealand and similar in Australia. So essentially what happens is when you get paid a dividend, there's sort of a double tax kind of situation happening. So again, let's take that same $100 that a company earns. Typically what they're going to have to do is they're going to have to pay tax on that profit. So depending on where the country is, that tax rate is going to vary. Let's just say in this example it's 20%. So if they pay a 20% tax, that's going to leave that company with $80 to do with what they please. So they can either pay that as a dividend, like I said, or they can retain that and invest it somewhere else in the business. If they invest it somewhere else in the business, they've got $80. They can spend that $80 on opening new stores or expanding their website or whatever the business is. They can spend $80 on kind of going ahead and doing that and making a return. If they pay me a dividend, they can try to pay me $80, but what happens is I'm going to get taxed on that $80 just as if it were regular income from my job or something like that. So again, depending on your tax bracket, will depend on how much of that money you get to keep. But just for argument's sake, let's say that that's 20% again, just to make the maths easy. So we're going to get charged another 20% in tax, and that's going to take off $16, so that's going to leave us with $64. 80 minus 16, 64. So from $100 of profit, we're only going to end up with $64, assuming those are our tax rates, 20% and 20%. So there's a double tax situation, which is a massive downside of dividends, and another reason why I much prefer the company to reinvest that money themselves, or even just buy back their own stock if they do believe that those shares are undervalued. So that's the main downside. Like I said, we do have a system in New Zealand, Australia, where you can claim some of that tax back, and it's been argued against us for a long time, that this just isn't fair to the owners of the company, but it's the world we live in. The other final thing I'm just going to say on this is there may actually be a third tax come in. So if you're like me and you live in, if you don't live in the United States, I do invest in US companies. So I've currently got one holding in the United States. What may also happen is once I end up with this $64, after being taxed twice on that, you may also notice that your own local government wants to tax you on that as well. So I've been taxed by, the company's been taxed, I've been taxed by the US government, and now I may also get taxed by the New Zealand government. So let's assume I lose another 20%, again, just to make the maths easy. That's going to be about $12, so that's going to be, let's just call it $52 roughly. So I'm going to end up with $52 from being paid a dividend, all the way from the company that I, in theory, should own a piece of, earning 100. I'm coming right down to 50. I've lost almost 50% of that money, and that's a reason why I am very much against dividends in 90% of scenarios with the companies I own. So one final thing I'll talk about, and that is actually dividend reinvestment programs. I got a comment in a previous video that I did on a similar topic to this, that there's sort of a third thing you can do with your dividend money, and that is have it automatically set up to buy new shares in the company that you already own, so you're not just going to be kind of sitting on that cash. To be honest, the same rules apply. So you're still going to end up with only $52. If you've got someone to put that money, again, that's great. If you invested in the company that paid you the dividend, that's great. It's going to achieve largely the same thing as a share buyback would, where you just increase your percentage ownership in the company by buying more shares in the case of reinvesting those dividends, or by the company retiring shares in the case of share buybacks. Both pretty much achieve the same thing, other than the fact that you've only got now $52 to reinvest versus the company buying back $80 worth of shares and increasing your percentage ownership a whole bunch more. So that's my thoughts on dividends. I know a lot of people love dividends. I really don't. They're great for cash flow if you're in retirement or something like that, but I'm not. I'm 24 years old. I'm trying to grow my net worth rather than live on the payments from dividends or anything like that. So let me know your thoughts. Do you agree with me? Do you disagree with me? Leave lots of hate comments and dislikes if you do. Let's have an argument down the bottom, or a discussion at least. So let me know your thoughts. I hope you enjoyed the video. If you did, hit like, subscribe, and I will see you in the next one. Cheers.